The product department of an insurance company proposes launching a special life insurance product involving investment elements that allows clients to instruct payments to unknown third-party individuals via partner financial institutions. The product department seeks approval from the compliance department as quickly as possible because time to market is of critical importance for a successful launch. What is the best course of action from a compliance perspective here? There are 4 options, you have to select one. Option A, do not sign off on the product because it contains the option to make payments to unknown third parties, which carries a high money laundering risk. Option B, sign off on the product because client KYC is complete and unknown individuals can be added to or removed throughout the duration of the contract. Option C, do not sign off on the product because the compliance department was not involved from the beginning of the product development process, which is a severe governance violation. Option D, sign off on the product quickly to gain competitive advantage while evaluation by compliance can be completed later. You can pause your video. There are 4 options. One should be selected and we'll see the answer on the next screen. So option A is correct. B, C and D are wrong. Let's look at B, C and D and we'll come back to option A for details. So completing KYC, which is option B, completing KYC on the main client does not solve the problem here. The issue is not who the client is, the issue is who the money is going to. That's where the term came. Unknown individuals can be added, okay, or removed throughout the contract does not make them known, so they are still unidentified, still unscreened, and payments to them still carry the same risk. Client KYC and beneficiary verification are completely 2 separate things. Why C is wrong? Not being involved from the beginning is a genuine governance concern from compliance, and it's something compliance should raise it separately, but it should not be the reason to refuse sign off. The reason to refuse is the actual risk in the product itself. If the product was perfectly designed with no AML risk, the governance process issue would need to be addressed separately, not used as a reason to block launch. Okay. Then D, signing off quickly and completing the evaluation later is completely backward approach. So compliance review happens before launch, not after. Once a product is in the market and clients have signed up, it's far harder and far more damaging to pull back, and it is reputational risk for the organization as well. So commercial urgency never justifies skipping a compliance review, and a regulator would take a very strict kind of actions against such kind of things. Now coming back to option A, which is correct. So you see the red flag here, as we said, is right in the product description: payments to unknown third-party individuals. Think about what that actually means. A client takes out a life insurance policy with investment elements and then instruct payments to people that nobody has identified nor verified or screened. Those third parties could be anyone. There is no KYC on them, no sanction screening, no source of funds check. That's not a minor gap. That's a fundamental AML control failure built directly into the product design. No matter how much commercial pressure exists, compliance cannot sign off on a product that allows money to flow to unidentified individuals. The risk is too high and the control gap is too obvious. The right answer is to go back to the product team and redesign the product so that the third party payments can also be screened properly and are made to identify and verify those individuals before any payment is made.